There is something called long-term moving averages and short-term moving averages, and they are to be used quite differently. Hi there, my name is Russ Horn, and today I want to show you the difference between long-term and short-term moving averages and how they are supposed to be used. A lot of traders do not use, especially the long-term moving averages, quite right. So let's get into this. We're going to show you exactly what a long-term moving average is and what a short-term moving average is and how they are to be used. First of all, I'm going to add a couple of long-term moving averages. Now, the term long-term moving averages is simply a bigger number. We're looking at, basically anything above 20 is good for a long-term moving average. I'm going to add two of them. And what long-term moving averages are going to be good for is a bias or a trend direction. So let's add a 21. This 21-55 combination is one that I really like. So we've got a 21. I'm going to add a 55. And this 21, I'm going to make exponential. The 55, I'm going to turn red. And what we can see at this point is we've got a longer term moving average. So if I zoom out, we can see that the 21 will stay above the 55 for a length of time. And when it gets below the 55, it'll stay below the 55 for a length of time. And what these longer term moving averages are for is market direction. We are looking for a bias. We're looking for a direction that the market will most likely want to go. And this is what the longer term moving averages are for. Most people, when they get a set of moving averages, are instinctually looking for crossovers and taking trades on the crossover. And a long-term moving average is not meant for crossover trading. When you have a 21 and a 55 period moving average, oftentimes the market has to move quite a long way before we get a crossover of these moving averages. And in doing so, the market is often quite overextended at the time of the crossover. So when that crossover occurs, the market is most likely going to start moving back towards the moving averages themselves. We're always going to have this little dip right after the crossover of long-term moving averages. So don't get into the habit of trading a crossover on a longer-term series of moving averages. They are not meant for that. They're meant only for trend direction. They can be used as support and resistance. As we see, the market moves up and we have market bouncing off of the 21 here. We've got it bouncing off of the 55 here. They are good for support and resistance. It's called dynamic support and resistance. As the market moves, these trend line or these moving averages will move with the price, and often they will bounce off of these areas, but they're not meant for crossover trades. When we look at something smaller, like a 3 and an 8 or a 2 and a 5. So let's put that on the charts. We're looking at a moving average. I'm going to put on a 3 period moving average, also exponential. Let's make this one gray. And then we'll add, that's a little too light, make it black. And let's add an 8 period moving average. It could be 8, it could be 5, something small. And let's make this one a green color and hit OK. So at this point, we are looking more for entries. We can take trades based on crossovers or when the moving averages get very close together and then start to widen again. We could be looking at entries for these types. So once we have a bias, we have the 21 over the 55, we would be looking for long trades because this is the longer term series of moving averages. And once we have that bias established, we can be looking for crossovers of the smaller term moving averages to give us trade signals. So here's an entry to go long. We've got the bias that's up, the moving averages cross down, the short-term moving averages cross down, and then they cross back up in the direction of the trending market. And then we would have a long trade at that point. Another example could be here. We have a long trade at this point when the moving averages come together and then separate. And another instance in here, moving averages come together and then separate. So we have good indication that the trend's intact with the long term and then signals with the short term.